All right, so here we are with a notes payable example. And in this one, it says Sierra Company borrowed $100,000 from Tango Company on September 1st after they signed a 9-month note and agreed to pay 8% interest. Sierra paid off the loan plus the interest in full on the date of its maturity, journalized all the relevant events. So again, we're going to do much like the notes receivables example that we did back in chapter 7. We're going to do this one 3 times, 3 different examples. And it's going to look very, very familiar. The computation, the calculations are going to be very similar. We're just changing really the journal entries. That's the only difference that we're going to have. So let's get into it. First things first, we need to journalize us getting the loan, borrowing the loan. So we're getting cash. So 9-1, we're going to debit cash for the 100,000 because that's our principal. And then we're also going to credit notes payable because we're increasing our liability by 100,000. All right, that takes care of us just getting the note in and of itself. Then if we have any other yearly operational entries, that'll go there. And then we get to 12/31, because remember, just like we did with notes receivable, if it goes past December 31st, we need to stop on December 31st and do an adjustment for what we have either accrued or we have used or built up. And so 12/31 is our adjustment date. So we need to calculate how much of this interest have we accrued. How do we do that? What is our equation? Principal amount times the interest rate times the time expressed in a fraction of a year. And that's going to give us our total interest. Again, it's the exact same equation that we did for notes receivable. Okay, so what is our principal amount? What's 100,000? What is our interest rate? That's 8%. What is the time expressed in a fraction of a year? Well, this is a 9-month note, so we need to do 9/12. If this was a 1 year, then we would do 12/12, which is irrelevant, but just to do it for formality reasons. But this one's 9 months, so we'll do 9 months over 12 months. And that will give us a total interest of 6,000. So by the end of the life of this note, by the end of the 9 months, we will have accrued $6,000 interest. But that's not how much we've accrued up to December 31st. We need to figure out how much we've accrued just up to December 31st. So how do we do that? We take the total interest that we found, multiply it by the amount of time from start date to December 31st, and that will give us our interest incurred by December 31st. So our total interest is 6,000. The total amount of time from the start date, which is September 1st to December 31st, that's going to be 4 months of the 9 months total. So we'll do 4/9. And that will give us an interest incurred just by December 31st of $2,667. So now that we know how much we've incurred or accrued up to this point, December 31st, we can do our journal entry, which is going to be interest expense, because we're expensing this now. This is us using this. This is what we have to pay in order to use the loan. Interest expense of $2,667, and then interest payable, because we'll pay it back when it's due, of $2,667 as the credit. That takes care of the 12/31 adjustment. Now let's look at year 2. Year 2 comes around. Now we're at 6/1. That's the end of the 9 months. So we now need to pay it. But in order for us to pay it, we need to figure out what the remaining interest is. And again, the easy way to do it is 6,000 minus the 2,667. But again, just using it for computational purposes, here's the equation. Again, total interest times the amount of time from January 1st to the maturity date. That'll give us remaining interest incurred. So again, total interest is 6,000. The remaining time is the remaining 5 months of the 9, so we'll do 5/9. And then that will give us a remaining interest of 3,333. Again, if you add that to the 2,667, that'll give you the 6,000. All right, so now let's do our journal entry now that we have all this information. Well, we know cash is involved. Let's go ahead and get that out of the way. Cash, we're losing the cash because we're paying it. So we're going to go ahead and credit cash for 106,000, because that is the 100,000 principal plus the total 6,000 in interest. So that's what we're paying. And by paying it, what are we getting rid of? What is our debits going to be? Well, we're getting rid of our principal, which is our notes payable. So we'll go ahead and debit notes payable of 100,000. We're also getting rid of what we have in interest payable, which right now all we have in interest payable is 2,667. So we'll take that out. And then we have that last 3,333. That's going to be an expense because we haven't expensed that yet. We still need to expense it because this is in the second year. So we'll call that interest expense of 3,333. That's how you do a notes payable example when it starts in 1 year and finishes, the maturity date is in the following year. Now let's look at an example of what happens if it just all happens in 1 year. So pretty much the same stuff going on, except this time the note starts on January 1st and it's a 9-month note. So let's go ahead and do the journal entry for us getting the money. So again, it's going to be 1/1 cash of 100,000, notes payable of 100,000. Then we have our normal yearly operational entries. And then we get to 10/1. 10/1 is when the maturity date would be, and again, 9 months note. So it would mature on 10/1. So we need to do journal entry. And 10/1 is when we actually are paying this. So same equation, principal amount times the interest rate times the time expressed in a fraction of a year gives you your total interest. So let's put in those numbers: 100,000 for the principal amount, 8% for the interest rate, 9/12 for the time expressed in years, and that will give us the same 6,000. But this time we're not having to divide it up, because notice we're not going past 12/31. We're still within the same year. So with that, we don't have to put anything in payables. So we're going to lose the cash. We'll go ahead and credit cash for the principal amount plus the interest, so 106,000. Go ahead and get rid of the notes payable principal amount, so we'll debit notes payable for 100,000. And then finally, the last 6,000, we're just going to put in interest expense, because we don't have an interest payable. This is all within the same year, so we don't have it payable. We're just going to expense it outright all at once. So that's how you handle a notes payable example when it's all within 1 year. Now I'm going to give you one more example, much like we did with a notes receivable, is what happens if it's within days. So let's look at one more example. Sierra Company borrowed the same amount, but this time it's for a 45-day note, and it started on December 1st. Okay, so again, December 1st, cash, notes payable, 100,000, that's our principal amount. Any other yearly operations until we get to 12/31. This one passes the 12/31 mark. 45 days from December 1st would give you January 15th. If you break out your calendar and you count the days, remember you start with December 2nd. And so that gets you to January 15th. But we need to stop as of December 31st. So again, same equation. 100,000 is the principal amount. 10% is going to be the interest rate for this one. Time expressed in a fraction of a year. Remember, this is a 45-day note, and because it's in days, we're going to divide it by 360. We're going to use the banker's rule. We're going to assume that the year has 360 days rather than 365, because that's going to give us a nicer fraction. And that will give us a total interest of $1,250. Now, that's not what we're going to account for yet, because we haven't got all that. We haven't incurred all that $1,250. That's for the full 45 days. We're only doing it for a portion of it. So we got to break that down. So we'll use the equation again: total interest times the amount of time from the start date to December 31st, and that will give us the interest incurred. So $1,250. If you break out your calculator and count December 2nd, starting with December 2nd to December 31st, that'll give you 30 days. So we will do 30 divided by 45, because that's how much of it we've actually used. That will give me roughly 833. So we can go ahead and write that in our journal entry as interest expense of 833, and then interest payable of 833. All right, that takes care of the adjustment for the entries that we've incurred. Now let's go into year 2, where we actually pay it off. So January 15th occurs. This is, again, the end of its maturity date. So I need to figure out that last little bit of interest. Again, you can do 1250 minus 833. That'll give you the answer. But again, from an equations base, it'll be 12,050 times the remaining 15 days out of the 45 days. And that will give you the remaining $417. So if I put that into a journal entry, first things first, I'm getting rid of cash because I'm having to pay it away, because this is the money that I borrowed, so now I've got to pay it back. So cash is going to go down. Credit cash of the total amount of the principal plus the total interest, which was the $1,250. So 100,000 plus the $1,250 gives me $101,250. And my debits are going to be my principal. I'm getting rid of it. I don't owe that anymore. So notes payable, debit of 100,000. Interest payable, because I got to get rid of that, or I'm getting rid of that. Interest payable of the 833 that I have so far. And the remaining 417 is still going to be expensed because I haven't expensed it yet. So that's going to be 417 into interest expense. So that's how you do 3 examples of notes payables. Hopefully they made sense. Y'all have a good one.